Hi guys, my name is Shillyboy Mothiba. I'm a chartered accountant by profession. Yes, I'm coming from Intergen. I'm executive director at Intergen. I'm also a co-founder. What is Intergen? Intergen is a tax and legal consulting firm which specializes in wealth preservation for predominantly property investors. I need to thank Bruno earlier on. He touched on the very important concept. We always look at three fundamental principles, as Bruno has highlighted earlier: the financing optimization and asset protection and tax efficiency. As a head of tax at Intergen, I'm so passionate about how do we utilize tax to actually better preserve that wealth that you guys are working so hard for, right? So what do we mean by saying tax efficiency, guys? Okay. So what we need to be careful of is the long-term part of it and the short-term part of tax structuring. But what do we mean about short-term part of it? When it comes to short-term tax planning, there are certain principles that we need to bear in mind. You may find that you invest in property, for instance, or you're creating wealth, for instance, but then you want to distribute that particular wealth as and when you are creating that wealth, right? That's what we call distribution fundamentals, right? Now, you may find that you are creating this wealth worried more about your legacy, about your generation, about your kids, should you pass on, meaning that you don't want to distribute right now in a short term, right? And you may find that, hang on, I'm about to retire in 10 years time, in 15 years time. I need to build up enough capital to retire in a long time, in 15, 10, depending on what's your time frame. So now, that's what we call compound effect. So that actually is a fundamental importance in how we're going to structure your property portfolio. Now, what do we mean about long-term tax planning? Here's an example. You've got properties in your personal name, say 10, 15, depending on how aggressive you are as a property investor. Now, what you need to bear in mind, especially those of you guys who actually amass a lot of property, you're doing very well, good is for you. You're doing very well, but however, you're putting all this wealth in your personal name. What's the catch? The catch is the fact that should you pass on, God forbid, should you pass on, you will be subjected to what we call an estate duty. And an estate duty, it's coming from what we call dutiable amount. Just on a high level, basically is the tax that get paid on what we call deceased estate, right? Is the wealth that you leave upon your death. So there's various calculations without dwelling too much in the technicality of it. So what it says is that 20% of what we call dutiable amount, right, from above 3.5 to about 30 million will be subjected to be taxed in the current tax legislation. You'll be subject to 20%. That's quite a lot of money after working so hard for years, and you lose 20% of your wealth. Beyond 30 million, which in most cases, you as a property investors, I know you're working so hard, the chances are you might actually be worth even more than 30 million. In that case, you will be subjected to about 25%, anything above 30 million. That's a long-term tax planning that you need to bear in mind as a property investor. With that said, when you die, from long-term tax planning point of view, when you die, it's considered what we call deemed disposal in any properties that you have in your personal name. You'll be considered to have been deemed sold those properties, meaning that it triggers what is capital gain tax. I will later on explain what is capital gain and what are the tax implications for that, right? But let's just look at it now. So meaning that you will be subject to what we call capital gain tax, right? So a capital gain tax in a natural person, which is me and you will be taxed at inclusionary rate of about 40%, depending on what's your applicable tax rate on the date of your death. Let's say for worst case scenario, or maybe you've been high earner, which most of you guys are doing very well, curious, you'll be subjected to at 45%, which is highest applicable tax rate for individual. Effectively, that's about 18% gone 18% of your wealth gone as a result of capital gain tax. Now, there are also issues of transfer cost, because we need to move and unwind some of your deceased estate, move it from your personal name, whether to your kids or public benefit organizations that you might have nominated in your wills. That is not the point, but the point is that you're going to lose money from what you call transfer cost, because you're going to have to pay legal fees, you're going to have to pay bond cancellation fees, so which can be quite a huge amount. Things like valuation costs, you don't want to lose. Effectively, when we run the numbers, it's pretty much just over 30-something% to 40% that of your wealth on the date of your death. So that's a long-term tax planning that you need to bear in mind. So now, when we go back, we always need to say, okay, how do we then strike a balance and find an equilibrium point between the tax, finance efficiency, and asset protection? This is where we come in. We structure your affairs, and we involve things like trust in such a way that it builds up that asset protection. It provides with asset protection, because what it does, it separates between the ownership and the enjoyment, the enjoyment benefits. You can still enjoy the benefits that comes with owning property, wealth, but without actually owning directly those properties. Now, but then in a short term, how do you then benefit? If you're one of those people who say, listen, Shillyboy, I want to get into property space, and I want to be able to live off during the years. I need to pay school fees for my kids. I need to go on these expensive holidays, Maldives. Oh, these days even you guys are going to Bali. How do I make sure that I actually go to Bali? Right? We use what we call a conduit principle. Now, what is a conduit principle? Because you probably heard it many times and people are just confusing. Hey, there's a conduit principle, and also trust is expensive to actually be putting properties in your trust. Hang on, let's take a step back. Now, a conduit principle is a simple fundamental which is coming from a common law. It has been sort of included in an income tax legislation, right? We codified it in South African tax environment. So what then it does, it allows you to distribute what comes into the trust in a particular year of assessment and to your beneficiaries. It might be you, it might be your kids, it might be your parents. Black tax. Right? Yeah. So we need to take care of those without even coining it. But you need to take care of your parents. It's the right thing to do. So now, what do we do? So we can distribute whatever comes into the trust and goes out in the same year of assessment. What it does, it's a common law code. What it does, so it makes basically retain its nature. So if rental incomes comes in, and then the trustees make a decision, which we can help you act as an independent trustee. By the way, as Intergen, we provide such kind of fiduciary services. So you're more than welcome to reach out to us. Now, what do we then do? We say, okay, there's a resolution that needs to be passed. We need to distribute, say, 10,000 to your parents. We need to care for them. So we can distribute. Remember, you in a short-term tax planning, you want to do what? A distribution model. So we can then say that 10,000 of rental income that comes in, and then we distribute in the same year of assessment so that it doesn't get taxed at the trust level, which answers your concern to say, I can't put properties in a trust level because trusts get taxed at higher tax rate. Yes, so, trusts get taxed at 45%, but you can tax plan it smartly just by using a conduit principle. We then distribute that to your parents or your kids. We pay school fees. Then they get taxed at that lower, because I presume that there might be not any income because you're even taking care of them, right? So meaning that they're at the lower tax brackets compared to a trust or a company. That is a short-term model, right? Now, let's say you want to use a compound model. Say, listen, Shillyboy, I'm well sorted. I've got enough salaries. I can take care of my parents. I can take care of my kids. So now, what do I need? I need to build up my retirement. I don't want to be a burden to my kids, which is the right thing. So now, what most people do then, we say, okay, fine. When we compare the three investment vehicles that are possibly out there, which is individual, a trust, or a company, we already know, we concluded it's a no-go area, individual capacity. I already earlier on highlighted why it's a no-go area. So now we say, okay, we are left between a trust, basically, and a company. The cheapest one, because we're not distributing. We can park all these properties at the trust level because we're not distributing, right? We can't utilize the conduit principle because you don't need the money. You're sorted. You might be earning some of the money, whether it's salary or other side hustles. That's okay. So now what we say, okay, what is the cheapest effective way to put and park all these properties? We'll typically put them at the company level, but we still need to maintain what Bruno said earlier, the asset protection, right? Then we still need the ownership that is owned by a trust that we can help you and structure it. So now what then we do, then we say, okay, so this is a compound effect that we're going to do. We build up these properties in that particular, in the company. There are people, like Bruno said, where people say, no, for asset protection, I don't want to put all my eggs in one basket. I want to have multiple companies, company A, company B, company 3. It's okay. You can do that, but you also need to be careful, right? You need to be careful of not compromising the financing optimization, which is, I don't want to dwell into it because Bruno has detailed that earlier on in more detail. So that's typically what we'll do. Then effectively, you'll find that effective tax rate at the company level is actually cheaper when you compare to the benefits of actually compounding that, and you are able to grow your wealth. So that's pretty much what tax efficient in a high level, what it means. But we can go into all the technicality. There's quite a lot of things that goes behind moving of money. How do we move money from the company to the trust? How do we make sure that we preserve this money? Because what we normally use, we use a double trust model where we've got a property trust and a family trust. So yeah, so we need to make sure that that is important and can be taken. So that's a bit technically. So in a nutshell, thank you so much. Thank you for watching. And I look forward to see you and consulting with Intergen. Thank you. My name is Shillyboy. I'm a director, head of tax at Intergen. Thank you.